You gotta laugh a little, cry a little, before the clouds roll by a little.
Hello everyone, Curtis Chambers here with the Chambers Financial Group. Please stay safe out there. That's the most important thing. I've covered in recent videos what we can expect from a bear market over the long run. Today, I'd like to look at what we may see during the short term, and specifically at something termed a dead cat bounce. I'll also touch on the most likely event that will precipitate a market recovery, the perils of market timing, and I'll share some good news about how the private sector is combating the coronavirus. During a bear, it is common for the market to rally upwards, then go down again and retest lows. A dead cat bounce is defined as a brief rise up before a return to market lows. I prefer to call it a bear cat bounce when it occurs in down markets because I like cats. We just had a bounce with the market up over 20% since March 23rd. Is this just a bear cat bounce or the start of a long-term rally? This chart shows cat bounces are a frequent phenomenon. During the tech wreck of the early 2000s, the S&P 500 bounced 10% more than 6 times. And in 2008, stocks bounced more than 10% 3 times, with one huge 27% rally in late 2008 before faltering again. As I've said, I suspect this bear will be short, but the moral of the story is cat bounces are normal during a bear, and it is good to be prepared for ups and downs so we are not surprised or disappointed. On the economic front, we are suddenly in one of the worst recessions in U.S. history. Things are rough out there. Jobless claims, which come in weekly, are probably the best economic indicator to get a sense of what is really occurring out there on the ground. Here we see more than 6 million people filed new claims for unemployment in the week ending March 28th. That's the effect of the government shutdown precipitated by COVID-19. And here we see the U.S. jobs market posted the first decline since September 2010. The magnitude of the loss is evident. On a happier note, on what basis can we expect a turnaround? Well, we believe the key will be finding confidence in the peak of COVID-19 cases in the U.S. This chart can be a bit odd to read. The blue line shows the S&P 500 inverted, meaning declines are shown by a rising line. However, the strong correlation between new cases of COVID-19 and the market is remarkable. As you can see, when the coronavirus cases worldwide showed some decline, the market rallied. Remember, the market looks forward 6 months to a year. I believe the driver of the market recovery will be when there is evidence COVID-19 is starting to come under control, not when it is eradicated through immunization. This is why the market may recover more quickly than the entire economy and faster than is usually the case with recessions, in my opinion. What about market timing to take advantage of the dips in the market? If the economy is suffering these tremendous shocks and ups and downs, and if the coronavirus is still in full swing, does it make sense to go to cash and time the market before getting back in? Although market timing may seem appealing to many investors, in these uncertain times, there are risks. If you started in 1990 and invested in the S&P 500 and missed the best day of the year each year, your annual return would have been reduced by 50%. Miss the 2 best days of the year and your return is almost gone. Miss the 3 best days each year and your return would have been negative. Since large upswings can follow down markets, being in cash is a big risk. Is there a recent example of a large upswing following a down market? Oh yes, that would be the week of March 23rd that we just had. It was the best week in the market since 1934, and since that time the market is up 23% from its lows. And now some more good news. Will innovation defeat the coronavirus? COVID-19 has caused the loss of life and loss of trillions of dollars of market value. How quickly will a vaccine be developed? The answer relies on using innovative technologies. Innovation has driven advances in vaccine technology that are shortening the time it takes to develop trial-ready vaccines. Scientists can now develop and tweak DNA directly, allowing the discovery of the correct antigens more quickly. Back in 2003 with SARS, it took 20 months before the first human trial. This February, just 7 weeks after COVID-19 was identified, and only 42 days after the virus was genetically sequenced, a U.S. biotechnology company shipped a potential vaccine for human testing to the National Institute of Health. While we will still have to wait for another year for the vaccine to pass human testing, the process has been greatly accelerated because of human ingenuity. At times like this, when bad news seems to dominate, the good news is out there, just harder to find. If you've got questions about Bearcat bounces or market timing, please give me a call or arrange a virtual meeting. We're not in it for the short term, not even till the cat bounces. We're in it for the long run.
You gotta win a little, lose a little, and always have the blues a little. That's the story of, that's the glory of love. That's the story of, that's the glory of love.